The Precious Metals Week in Review, July 2nd, 2015. Brought to you by Precious Metals International. Volatility continued this week as the drama between Greece and its creditors came to a dramatic conclusion. Poor economic data was released out of China, and a sudden resurgence of fear arose over Puerto Rico's ability to pay its own debt. This week will see a shortened trading week due to a holiday on Friday for observance of the July 4th Independence Day holiday in the U.S. The number of Americans filing initial claims for state unemployment assistance jumped substantially higher by 10,000 claims for the week ending June 27th. But you would not know that by watching the news this week. The mainstream media outlets seemingly forgot to post the data on Thursday, choosing to focus on the early release of the non-farm payrolls report for June instead. The previous week's data remained unrevised, leaving the seasonally adjusted claims level at 281,000, which remains below the key 300,000 claims figure closely watched by economists for judging the state of the U.S. jobs market. The June non-farm payrolls report was released a day early this week due to the 4th of July Independence Day holiday falling over a weekend this year. U.S. markets will be closed on Friday in observation of the holiday. The week has been full of analysts spouting that the June jobs report would likely be off the charts and show that the U.S. Federal Reserve should go ahead with an interest rate hike in September. The release of the official report on Thursday, a day early, sent these same analysts scrambling to explain away a weaker than expected report. The 223,000 additional non-farm payrolls that were added in June were less than expected by analysts, and a dip in the unemployment rate to 5.3% was primarily attributed to continued record lows in the labor force participation rate. Quite simply put, the number of people out actively looking for jobs in the U.S. appears to be at the lowest rate since the 1970s. Economists, which only yesterday were saying a rate raise is coming in September, suddenly found themselves adding, or maybe December, to that phrase. Puerto Rico surged to the forefront of the news this week, apparently competing with Greece to see which country has the most debt woes. Puerto Rico's governor, Alejandro Garcia Padilla, said that his island's economy was in a death spiral and said that Puerto Rico's debts were not payable. His statement regarding payment of the island's debts turned out to be inaccurate, at least for the moment, as a slew of payments worth nearly $1.9 billion were made on time on July 1st. Despite the on-time nature of the payments, Moody's Investor Service downgraded Puerto Rico's general obligation and guaranteed bonds to CAA3, further into junk territory. The downgrade is on approximately $55.5 billion in bonds and indicates imminent default with little prospect for recovery. Moody's said Puerto Rico's restructuring plans were clear signs that holders of even those Puerto Rico securities with strong legal protections face significant loss. It appears unlikely that a limited restructuring excluding those better protected bonds will be sufficient for Puerto Rico to gain the relief desired. Data released from South Korea this week showed a sharp drop in industrial output in May, adding additional fears over the growth level of an economy already sharply down due to an outbreak of Middle East respiratory syndrome. April's factory data was also revised lower, showing a 1.3% drop in output. Manufacturing activity for the month of June also showed contraction, falling at the fastest pace in close to 3 years according to the Nikkei Market Purchasing Managers Index, PMI, a private survey on manufacturing levels. The PMI number came in at 46.1 in June, the fourth month in a row that the figure has come in below the level of 50 that separates expansion from contraction. China's stock markets continue to take a beating this week amid continued soft economic data. Despite additional interest rates and required reserve ratio cuts that were announced by the People's Bank of China, PBOC, over the weekend and which went into effect on Sunday. China's stock market has seen a plunge of over 20% in the last 2 weeks and now appears firmly entrenched in bear territory. Monday saw another plunge in the market despite the PBOC's announcement, which may indicate that investors in China are looking for the central bank to do more in the way of monetary easing. Erwin Saft, Macquarie's head of China strategy, told CNBC on Wednesday after continued declines in Chinese stocks that clearly the PBOC will be very worried with what they see today, and they are likely to look at what other things can be done. The situation in Greece deteriorated dramatically this week as Athens missed its deadline for making the 1.6 billion euro payment that was due to the International Monetary Fund, IMF, on Tuesday, and Greece saw its previous bailout program officially expire. A planned referendum in Greece on Sunday to allow the people to essentially vote yes or no to the proposed reforms and bailout program requirements of international lenders is the latest news in the ongoing drama. Prime Minister Alexis Tsipras was urging the Greek people to vote no on the reforms, saying that doing so would give him a better negotiating stance with Greece's lenders. Eurozone finance ministers have warned that a no vote by the Greek people will not improve the negotiation position for Greece, but would rather harden the stance against further assistance. The firebrand Greek finance minister has said that if the people vote yes on Sunday, he will resign his post. Brent crude oil remained over $60 a barrel this week as the June non-farm payrolls report came in weaker than expected in the U.S., and new orders for the U.S. factory goods fell more than expected in May. The long weekend, uncertainty over the situation in Greece, and the stalled nuclear talks with Iran may mean increased volatility in oil in the short term. The euro began the week with a steep, near-vertical drop against the US dollar as the crisis in Greece seemingly spiraled out of control. By early Monday morning, the euro had clawed its way back higher against the dollar, but the continued wrangling between Athens and its international creditors resulted in a downward trend for the rest of the week. The euro appears set to close the week out lower against the dollar, based on data as of Thursday. The Japanese yen began the week moving the exact opposite of the euro, spiking suddenly higher against the US dollar at the start and seeming to trend higher through Tuesday. Tuesday afternoon saw a downward trend begin for the yen, but based on data as of Thursday, it appears that the yen will still close the week higher against the US dollar. Volatility should be expected to continue. This weekend will likely be extremely volatile for markets next week. U.S. markets will be closed on Friday in observance of July 4th, which will likely cast uncertainty over how the U.S. markets will react to the weekend's news out of Europe. The results of a referendum in Greece over the weekend on the proposed reforms and bailout requirements that would enable it to receive additional bailout funding will likely have huge implications for all market activity when Asia opens at 6 p.m. New York time on Sunday evening. China's stock market, already officially in bear territory thanks to a greater than 20% drop in recent weeks, may see another sudden plunge at opening on what will be Sunday evening NYT as it digests the news out of Europe. In Sweden, the central bank made a surprise interest rate cut to negative 0.35% and expanded its quantitative easing program, saying that uncertainty abroad had increased and it was difficult to assess the consequences of the situation in Greece. The European Central Bank did not cut off its emergency liquidity assistance, ELA, to Greek banks, despite Tuesday's default on the debt owed to the IMF. But neither did it expand the program to assist with a growing cash shortage in the beleaguered and debt-laden country. Capital controls have been in effect all week as banks opened sporadically and only for minimal hours. Greek people were restricted on the amount of cash they could withdraw from their accounts at ATMs and branches. The cash crunch is not just affecting everyday Greek citizens, but also import-export-based businesses that are dependent on paying suppliers outside of Greece. These businesses have already begun turning down credit card purchases for fear that those debts may not ultimately be paid back to them. Many, if not all, Outside suppliers of goods that are imported by Greece-based companies are now demanding advance payments before agreeing to ship their goods. These demands are affecting heavily import-based industries such as manufacturing, pharmaceuticals, and food. The situation in Greece is fast destabilizing, and that does not bode well for the rest of Europe. Daniel Speckhard, former U.S. ambassador to Greece and Belarus, discussed the situation on CNBC's Squawk on the Street program this week. Mr. Speckhard said, Greece is a member of the European Union and NATO, both consensus-based organizations. If things fall apart and they are angry and upset, they can play a real spoiler in both of those institutions on issues including Russian and Iranian sanctions. Mr. Speckhard also noted that the destabilization of Greece presents further problems globally, saying, it's basically the back door for people from the Middle East and refugees from around the world into the European Union. And if they don't monitor that, you could have some nefarious characters working their way into a free European travel zone to the rest of Europe, and eventually to the United States. If Greece falls apart, it would not be hard for someone to obtain a Greek passport, even if he or she is not a true Greek. As we enter what will be a long weekend for US-based markets, it remains vital, this week especially, to monitor global news outlets over the weekend. Regardless of the outcome of Sunday's vote in Greece, there will be no quick fix to that country's financial and political woes. With China and elsewhere in Asia continuing to slow, and Puerto Rico apparently right behind Greece, as evidenced by an alleged near default on its own debt this week, there are so many macroeconomic uncertainties across the globe that none of the market analysts can possibly know if everything is priced in as they believe or, instead, somehow interrelated just as the U.S. housing market was to the rest of the global economy at the start of the current financial crisis. If fear and uncertainty begins to rule the day in Europe, demand for physical precious metals may suddenly spike in a spectacular fashion. Wise investors have stayed the course, steadily accumulating physical precious metals as part of a well-diversified investment portfolio in the event that a plummeting stock market suddenly leaves them overexposed to equities. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Weekend Review, July 2nd, 2015. Brought to you by Precious Metals International.